Well, good morning, everyone, and welcome to the free webinar on pairs trading, an upcoming class that I will be teaching. This is Mark Fenton. I am the Senior Mentor with Sheridan Mentoring. A little bit about me, I've been trading for about 20 years. Back in 2005, I went through the Sheridan Mentoring program myself. Worked so well for me that in about 2 years, I was mentoring part-time. And in 2008, I became a full-time trader and mentor here, and I've been doing that ever since. So 5 days a week, of course, I'm trading myself. I get to see what has and hasn't worked for me, and I get to see what has and hasn't and does and doesn't work for other people. So try to pretty much keep a constant finger on the pulse of what's working in trading. And what I'm going to do here is starting next Monday through next Thursday, and then the following Monday through Thursday. So that'll be then not this week, but the next 2 weeks, Monday through Thursday at 9 a.m. Central Time, about 30 minutes after the equity market opens. We'll meet here for this class, and we'll look around for trades, trading pairs in futures trading. So this class will run Monday through Thursday for 2 weeks, starting next Monday. Classes should be around 30 minutes. That's give or take. Let's see what's going on in the market. Might be more some days, might be less some days. And you'll be able to email me and ask questions between classes. However, we're going to see what we're going to do in this class. This should answer a lot of questions. This is pretty much a trading class. This isn't going to be a class with presentations and a lot of rules and guidelines. We certainly will have them for a trade, but it won't be an in-depth study of an option strategy or anything like that. This is different than anything we've done. This will be mainly, where do I go to find trades? These pairs trades. Pairs trades being you sell one future or future month or duration if you're using bonds, and you buy another, or vice versa. So what you're doing is you're playing one asset against another. You think that one asset will go up faster than the other or down faster than the other. So that is what pairs trading is. And I'll be sticking in the futures market. We won't be doing equity pairs. It'll just be bond futures, oil futures, maybe some agricultural futures, certainly currency futures. These will all be things that we look at. And we're going to place live trades. I'm going to try to do one each day if we can find one. And also then the subsequent class, we're going to follow up with the class we had. So next Monday we find a trade, we put it on. Next day we talk about, did we get out of it already? Are we still in it? And we start looking around for more trades. So this class will build on itself. And hopefully, like I said, most days the class will be able to find new trades, should be able to. That's one thing about doing these pairs is you can usually find something to trade that has reasonable chances. Now, as I said earlier, you could contact me in between the classes with questions. All the trades, though, in the class will have an exact profit and loss plan. So, for instance, let's say we said, hey, we're getting in this trade here, and we are going to exit if we make $100 or if we lose $150. It'll probably be as simple as that in a lot of these. Those are just numbers I threw out. None of the numbers actually may be different as far as what we're going for P&L-wise, but it will be like that. So if you come to the class, you're going to have an exact plan. You won't be in between classes going, what do I do? We'll have already said, hey, if I buy September oil and I sell December oil, if I'm ever up, whatever, $200, close the trade. If I'm ever down 300, close the trade. So all you have to do is look at your screen. Am I up or down? Am I up 200? Get out. Am I down 300? Get out. It'll be that simple. So it shouldn't lead to a lot of confusion and what do I do here and that kind of thing, because we're going to cover that in class And of course, you can ask all your questions in class, but if something comes up, you have a question in between class, maybe you didn't understand a concept or something, you can always email and get some support from me in between classes as to what we're doing with the various trades. All right, so what a class will look like is I'll take you out to a couple of websites I like to use. We'll look around there, the same thing I do. Look around there, we'll look at what may be a strong or weak currency or future, and then we'll go out and see how well we can trade that. So today I'm going to just go over with you a little bit about oil and doing what they call a futures calendar spread in oil. Now, it's not a calendar or time spread like you may be used to in the options market, where you're buying and selling options. You know, you sell, say, the SPX 2840 call for next Friday and buy one for 2 Fridays later. This isn't that kind of calendar. This will be, for instance, as I mentioned earlier, selling 1 month of crude and buying another, and vice versa. All right, so let's take a quick look at that, at crude here. I'm going to share my desktop. So today is really going to be a brief overview of things that we will be doing, okay? This isn't necessarily going to be a live trade today, but we're going to talk about concepts that we'll be using in this class day after day. And what you can do is you'll learn a lot about pairs trading and how you can plug it into your own particular trading plan. I like to do some pairs trading, and then I, of course, mainly do equity options, a lot of SPX strategies, option strategies myself, but then I also plug in some of these pairs trades whenever I see opportunity. All right, so I'm using the TD Ameritrade Thinkorswim platform here, and I just put in /CL, which is crude oil, and whenever you just put in the simple 2 letters of the symbol without a month symbol, you see all these are months, U8, September, V8, October, X8, November, all the different months. But if you just put in simply CL, it brings up all the months and you can look at them. Now, one of these futures is going to be what they call the active. So that's the one that's being traded the most. You can just go over here and look at volume and tell that. However, you can also see how many days are left in that future. Well, there's only 8, so we know what's going to be happening is this future is going to be rolling, isn't it? The active month will roll from U8 to V8, all right? And when that gets whittled down, it'll roll from V8 to X8. That's how futures work. They roll from one month to the other. Now, some futures have expirations or have futures expirations every month. Some don't. For instance, your ZV, your 20-year U.S. bond, it only has 4 months a year. But those 4, it's always trading, but there's only 4 months a year that are active. The rest of the, many of the others have a month of every year, like something like oil or gasoline, which is another thing we'll probably look at. Because oil and gasoline can be great things to use because they're lower risk if you do them that way. If I outright buy, you know, an oil future or a gas future for so the margin's higher, you know, 3 to 4 grand. I don't even do individual futures much. I normally one against the other, so I'm more familiar with pairs. And the reason I do pairs is because I don't have as much risk. You know, if you outright bought the October future here, not only is the margin more, you also have a lot of risk. Every penny in oil, as you see, it says 66.53. Every penny it moves is $10. So if it goes from 53 to 55, that's $20 that you would have made if you were long, or lost if you were short, or be down if you were short the contract. So what we want to do is we want to say, if we have an opinion in oil, we might want to pair maybe the nearer month. We'll just use October in our example today, and then we'll against a further out month, maybe November or December. And then margin will be lower, but the good thing about things, many of these futures, particularly oil and gas, is you can still get a lot of movement. You know, I've been up and down over $1,000 in a day with a simple buy one, sell another in oil, buy one, and gasoline, probably even more so. Pardon the pun, but gasoline is very volatile, even compared to oil. And you can be up or down, you know, hundreds, depending on how it goes, in something like oil or gas. Now, things that we'll use like bonds, that can happen, but it's usually a little slower, or the currency futures, usually a little slower, but these can be a bit of a mover, both in your favor or against you. So this is definitely a market where I think pairs makes the most sense because of the amount of price movement. If you're in the room and you have any questions along the way, put them here in the chat feature. It should be in the lower right hand of your screen. There's a box there. You type your question or comment in and hit send. I'll get to those questions either sooner or later towards the end. All right, so let's talk about oil here specifically. Now, let's go over to the charts. And we're going to use CLV8, because it's going to roll here very shortly, and there's no point in getting into something that's going to roll on you in a few days, and your broker's going to say, hey, you know, next Monday you got to be out of this or we'll roll for you, and it's just a pain you don't want to do. So we'll use something with more time. So first I want to look at just CLV8. So C/CLV8. And by the way, you can go to cmegroup.com, and that's a great place just to learn about contract size, margin, tick size for any of these futures that we're going to be trading, because they have different ones. You know, every penny in soybeans is $50. Every penny in oil is $10. So it's good to go over there and get yourself educated as to what the tick size is, contract size, trading hours. Although because of electronic trading, these trade almost 24 hours a day from 5 o'clock Sunday evening Central Time to 4 p.m. Friday Central Time, U.S. And there's a little, maybe an hour and a half off for accounting purposes during the day. But pretty much you can trade. These are basically 24-hour markets. One good thing about that also is that you don't have as much gap risk. If you guys have traded in the equity market, I bet you know what gap risk is, where you had a position on, say, in the SPX, and then it opens up down 20 points or up 20 points. You have, you know, it's very difficult to defend that, right? Very difficult to defend that. So, if something's trading 22 and a half hours a day, well, there's very little chance of that gap, isn't there? Because there's such a small period for news to come in or something that would move that market and gap it. I've seen it happen, but very rarely. You know, probably more drastic times I've seen it with in bonds in 2008. Even then, it wasn't really that bad of a gap, maybe a half a point. Wayne Marling says, how about doing VIX futures? You know, that is not one that I look at, but that I don't trade the VIX futures as such. I like to use options in VIX futures, but it may be something that we look at because occasionally in this class, you know, it's always possible that we might do some little option trades in different futures, pairing maybe one against another, but this will mainly be 1 month against another. All right, so if we look at oil, we can see this is a daily chart. I like to look at daily, and then I really like to look shorter term, which I'm going to do here in a moment, because I like to get a broader overview where we've been, and then maybe dial it in to see what's happening in a shorter time period, maybe the 15 to 30-minute chart, because a lot of these trades we're hoping to be in and out of quicker. So we can see that, of course, oil has been up a long way, and right now we're headed towards the bottom of the channel, really, kind of in the middle of everything with CLV8, which is the October future. Now let's look at CLV8 by itself. That's the December future. you can see it's very similar, right? But what you can also do is you can look at them against each other in your chart by simply putting in this case CLV8, and then this minus sign, and then the / CLZ8. You hit enter, and now we're looking at where's this thing been. You see, it's a little bit different, isn't it? It's closer, really, to the bottom of the channel, isn't it? It is closer to the bottom of the channel if you compare one of them against another. And a lot more choppy move. Look at all this. This is tradability. Boom, 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 boom. Get on, get off, get on, get off. You see what I mean? That's what I like about these. Get in the trade, get out of the trade. So now let's dial this in to a 30-minute time period. Well, wow. It looks like we've taken a bit of a dive even further down here. So we're really getting to the lower end of the range. Now we'll go on down to 15 minutes. And now what's that tell you? This is kind of interesting. It's worked out even better than I could have hoped, because you see it says you're at the bottom, but it's starting to turn, at least in the shorter term charts, isn't it? Starting to go back up. You can definitely see we're in the bottom part of the range, right? And now it's started to go back up. So I like to use the charts. It's simple as support and resistance. I think pairs trading in futures works well with that. Where are we at in the chart? Are we near the bottom? Get long. Are we near the top? Get short in general with the charts. Now, you also are best if you're aware of some fundamental things going on. And then with that, you know, a lot of things you're going to have to create an opinion. I'm sure you guys know that whatever you do in trading, there's always somebody that'll tell you you're a genius for that opinion, and other people that will tell you you've lost your mind, right? So we always have that going on. So let's talk about oil a little bit. Of course, over the weekend, OPEC in general said, hey, we increased production. However, the largest producer, Saudi Arabia, actually decreased production. So there's a little bit of, in this case, believe it or not, in OPEC, that is kind of the tail wagging the dog, right? That Saudi Arabia is the big producer and the most influence in the oil market. But the rest, sometimes what happens, and you can kind of see it even in this news in kind of a microcosm, Saudi Arabia has a lot of money and a lot of oil, and they have what you know in trading we call stronger hands. A lot of times they have the ability to not sell as much. They're okay, but a lot of these countries, they don't have anything. I mean, they got oil. They don't sell oil. It's like if I don't go to work, I don't get paid. Well, a lot of the OPEC countries are like that. So there can be some weakness in these other countries. That's probably one of OPEC's, thankfully, for the rest of us who have to pay for gas and oil. One of their biggest problems is the countries all, of course, have their own agenda, and sometimes you can even see cheating or not cooperating one country to another because, you know, just the financial situation of a country. I'll get it out here. So, to me, the fact that Saudi Arabia's cut production, maybe the others were up, I'm not too shook up about that. I know the market, the oil market's down a little bit over that news, but I think that that's probably a little bit overdone. This chart tells me this is a little bit overdone also. And then also, there's a lot of unrest. You know, this whole thing with Turkey and everything. That kind of international turmoil, particularly with countries in the Middle East, particularly if you get any kind of threats going, well, that can really send oil for a ride, right? Because you get a lot of volatility and concern with that. So if we want to take advantage of that, what we can say is this. So if you're doing this chart, first off, whatever is first in your two letters, CLV8, that's the one that you're, if you want to buy, that's the one you buy, and then you sell the second one. If we were up here and wanted to sell this pair, we'd be selling the first one, CLV8, and buying the second one. So remember that. This is, CL is the lead. So in any pairs trade, you look at the first one versus the second one. And then whatever you want to do based on that chart and or fundamentals, you do based there. So in this instance, we want to buy CLV8 and sell CLZ8. Now, why would that work in general anyway? Well, the reason is that what we're saying is we think oil is going to go up in the near term. So in the near term, if oil goes up, let's go back over here and we're going to look at this again. If oil really wants to go up, most of that action is going to be in the front month. People are going to buy the front month, which will soon be CLV8, or it's certainly closer than Z. People buy that. So they will buy that, and CLZ8 in this instance, it'll go up too, but much slower. Take a look here. Just like when it goes down. See, oil is down 26 in the front, or the nearer months, but down less. So what's going to happen is you're going to get a lot more movement in your front month than your back month. So if you want to get long oil, for instance, you get long the front month, sell the back month. Now, they might, like I said, both go up, but the front month will have more advantage. Now, what's the problem with this? Well, what if we're wrong? So if we're wrong, yes, that front month can go down harder, as you can see here, 10 cents difference. But it is a way of hedging yourself. So if you wanted to do this trade, now I'm going to mock it up here and we'll see what the margin is. One easy way to do this, if you have the TD Ameritrade platform, is change. We know we want to buy CLV8 and we know we want to sell CLZ8. Now, you could go out and do that individually, but that's kind of a pain, isn't it? They're going to hit you with margin for those few seconds when you don't have them both on. So you can execute them both at once here by changing this here to, let me use the annotator. So I'm looking right here, and its default is single. If it's single, we're going to change that. And we're going to change that to calendar. Then you look at all these individual months, and we know we want to do something with CLV8. You can click the little arrow next to it, and look what it does. It brings you CLV8 against all these pairs, and even pairs for next year. You see this 8 means things in 19, or excuse 18, and then when it gets to 9 behind, it'll be 19. You can see them all here. In case you don't understand the symbol, CLV8 versus CLZ8 right here, follow it over. What's that mean? That means October of this year versus December of this year. All right, so if we know we want to buy that, right, we want to buy the first one, sell the second one, you go over here and you click on the ask, which of course is what you do when you want to buy something. So when you click on that, it should auto-populate this trade down here in the bottom. Let me see. Oops. Oh, there it is. It did it. I didn't have it set up right. Okay. So when I clicked on that, it comes up, and what it says is it's 63 cents more, obviously, right now to buy the CLV8 than the CLZ8. So there's 64 cents difference between the two of them. So for 64 cents, I could buy this spread. And what do I want to happen? Well, I want it to, did it come up right? Yeah, it did come up. So we're selling, yeah. Of course, we want this to increase, don't we? If we buy it at 64, we'd like to sell it at much more, right? 74, make $100 bucks. 84, make $200 bucks. That's what we're after. Now, so let's take a quick look at what the margin would be. So the margin for this trade, the buying power effect, that includes, they're just talking about fees here, which I pay about $3, is $946. That's what will come out of your account if I did this trade, 946 bucks. So really, if I made $100, I made over 10%, didn't I? So if I bought this for 64 cents and sold it for 74 cents, then I just made $100 bucks, right? So, and you can follow it along here in the chart. Just want to show you that. So that's how this trade would be done. Now, if we did it the other way around, we'd get a credit. We'd want to buy back for less, that type of thing. But in this case, and this is the kind of thing we'll be doing, we'll be buying the CLV8, selling the CLZ8. And I think a real simple thing is, you know, is just the 10% or a little more than 10% rule. So all you have to do is, hey, I want to buy this for 64 cents. I'm going to sell it if it gets to 74 cents and make $100, which will be over 10%. That might be today, that might be tomorrow, it could be a few days from now. That's the thing about this, is it does vary as far as how long you're in a trade. And one thing to remember about oil, every Wednesday at 9:30 Central Time, they release the weekly inventory. That usually has an effect around it. So that's something we need to think about also. But this would be our basic trade. So if we did this here, let's go ahead. This is the paper trading platform, but I'll go ahead and throw it in there. And usually I find in this that you don't usually have to give up much. Now, you might have to get in a trade, give up a penny or two. Maybe we would have had to pay 65 or 66 cents, and that's fine. But every penny is $10, remember. So whatever I get in it, so since I got in here at 64 cents, I'm just looking for 74 cents, and I'm out. And this is the kind of thing we'll do in this pairs trading class. And it won't just be oil. It won't just be one future month against another, same futures month. It'll be different futures against each other. Euro dollars against Aussie dollars. Maybe the dollar yen against the euro dollar, the dollar against the euro. These will all be things that we'll do in this market. All right, so let's go back over here. I'm going to look at some questions. So you saw the margin. It says digressing a little bit. How is 56 cents? Low is 56 cents. How does that map to a specific strike on the put side to sell a put? Well, actually, that's why we're going to do it as futures. It can be very difficult to do that. And I've looked at that kind of thing. Some people sometimes ask me, well, couldn't I buy a call on the October oil and sell a put on December oil, or that type, or sell a call, excuse me, on December oil? You could. So you buy a call in one, sell a call in the other. But I found that you can get a little more, there's time decay involved. There's even more volatility in options and futures. So that's not something that I generally like to do. I have done it, but I think there's a lot more volatility with that, and it's just not near as peaceful. And by the way, you can put in a reverse order on this. You just, create opposite order. You could have an order good till cancel. You don't have to watch this thing to get me out at 74 cents. Let's go ahead and do that. Create opposite order. And, if we can ever get out at 74 cents credit, I'll even make it 75. And we'll make it good till cancel. So anyway, you can do that. And we'll do that for every trade. We'll set up a trade. We're going to talk about when we're getting in, when we're getting out. You can set alerts. You can go to this chart, for instance, where you have both of these set up and go, okay, hey, I want to know if this thing ever gets to 54 cents, please let me know, right? Because I'll be down $100. So all you'd have to do is click on that price, create alert, and then if the last, which is what I like to use, is ever at or below 54 cents, we're going to get an alert, however you have them, will notify you, okay? Phone, text, both, email. But so that is what this class will be about. Monday through Thursday, next week, and the week after, we'll go look for trades every day. I'm going to bring the new sites into it that I use when we start the class. And we'll go through it. We'll set up a plan for a trade. You'll have email support in between in case you didn't understand something about the plan or something comes up. And then the next class we'll review it, see where we're at. Maybe we already closed it for a gain or loss, and we'll look at new things. So any other questions from anybody about this class? I think you're going to find it very interesting. A lot of people, they don't do pairs trading, and you're going to find this is a fascinating new world. And one thing that's interesting, now you got to be careful here. It's not for everybody. You need to know what you're doing, and certainly if you're new to futures, you need to be doing these all on paper. Don't be using your own money. But if you're an experienced future trader, let's say you've done it a lot, you're not subject, by the way, to the day trading rule. You know, as many of you probably know, if your account's under 25 grand, you can't do very many trades in and out in the equity market or equity options market. What is it, 5 days or whatever it is? They hit you with day trading thing, and you have to, you know, get your account over 25 or they 1,000, or they can suspend it for 90 days or whatever. It's just kind of nasty. Futures, you don't have that, right? So we don't have to worry if I get in and out of this trade today. That's fine. If I did this in the equity market and got out of it today, and you happen to have a small account, that's what's going to happen. That'll be one, you know. And just talk to your broker. Sometimes I get a little confused as exactly how that works, but I think if you do that 5 times in 5 sessions or 7 sessions, then they can suspend you or make you put more money in. Doesn't matter if you won or lost either. Interesting. All right, so any other questions today from anybody? I'll give you guys a couple moments. I hope you found this fascinating and something you'd be interested in. I mean, that's class, what is it, 197? Of course, there'll be somebody's asking, will you teach criteria to go long or short? Of course, I just did, yes, and I'll continue it, you know. For instance, I told you why I want to go long here, right? I want to go long here because I think we're at the bottom of the channel, and I think this little blip down in the market's probably overdone, and Saudi Arabia will probably have more influence with the fact that they've cut production, and this will go back up along with global unrest. That's my opinion. All right? Always remember, you can always lose, right? Don't ever think you can't. All right? You can certainly lose, and you need to protect yourself. But like I said, if you're new to futures, then you need futures approval in your account anyway, but you also can just do this on paper or with a simulated program, whatever you want to do. Do I trade this way daily? I wouldn't say every day, Jerry. I don't do it every day. And the reason is sometimes there's not a trade, but probably the reason I don't do it every day is I have most of my attention and money that I trade in the equity market. This is a sideline to me, but I think it's fun, and you can make good money at it. It's a little more labor intensive than what I do in the equity market. Plus, I'm teaching people also during the day. So do I do this every day? No. Are there times when I do, or weeks on end every day? Yes. But I wouldn't say every day in my trading life I do this, no. But I do it a lot, all right? A lot. And I think it's a great way to make money. Well, you know, a lot of what I do is based, you know, these equity butterflies and things are based on time decay. So while you're waiting on things to decay, premium to decay and go in your favor, you can be doing this. So some people have time to be in front of the screen more, so they want to be active and do something. Well, there you go. You can do things like this. Or maybe, hey, 2 days a week you've got time for this. Maybe the other days you don't. All right. Then you can use those days to do it. So it's pretty, it's a great thing you can go in and out of, step in, step out, and a great supplement, I think, to an overall plan. All right, well, I hope you guys will consider signing up for this class. And there's a link on the website for it. And we'll start next Monday, 9 a.m. Central Time, a week from today. And we'll get in there and we'll look for some live trades. And we'll start building up over a couple of weeks on how you do this. Oh, of course. Yes, Jerry. Like I said, this is just the one I use for today. I'll be looking at pairs in currency futures, crude oil, probably gasoline, maybe agriculture, bonds, different duration bonds against each other. All right? If it's a reasonably liquid future and has an opportunity, I'll be looking at it, more than likely. Okay? And it won't just be, like I said, 1 month against another. It might be oil against gas or 20-year bonds against 30-year bonds, that type of thing. So this certainly will not just be one pair or one or two different futures vehicles. It'll be several. Okay. Well, I hope to see you guys next Monday, 9 a.m. Central, and we will talk then, and we'll get ourselves going with some futures trading. And you can, if you haven't already learned this, this can be a whole nother thing to learn. It's always good to have more arrows in your quiver, isn't it? More and more things that you know how to do. All right, folks, have a good one. Talk with you later. Bye-bye.